Hello, everyone. Welcome to this Options 101 panel. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Hope you've enjoyed the entire week called Options 101 week. We've gotten so many questions over the weeks and months, if not years, about options trading. And we at StockCharts are finding ways to help empower you to approach this market if you're less familiar with it. And this panel in particular was an attempt to answer the frequent questions we get about getting started in options trading. For many, it can be sort of an overwhelming idea to get into a new market, a new trading discipline, a new approach. And I found three pretty solid experts to help us answer some of the many questions that we've received at StockCharts over the years. Guys, I'm so happy to have the three of you join us. We have Price Headley. Price is the founder and president, chief analyst at BigTrends.com, coming to us from Lexington, Kentucky. Price wrote the book Big Trends in Trading, which, Price, I didn't tell you beforehand, but that was actually the first book. After I read John Murphy and Martin Pring's books on technical analysis, at some point I realized I needed to diversify a little bit into other books, and I picked up your book. So
well, I'm
for
honored.
better or
Thank
worse, you have that on you in terms of my success as a technical analyst has come from you and your work. But welcome and thanks for joining us, Price.
Thanks for having me, Dave.
Second, we have Lex Luthringhausen. Lex is coming to us from the Chicago area. Lex is the Senior Vice President of Business Development for Tradier, which is an online brokerage with stock equity and options trading. Lex has experience on the floor and off the floor. We were talking beforehand about his years in Chicago at the SIBO. Lex, I first met you through your work at Tradier, but coming on your own show, Options Brew TV, which is really well done. I hope people certainly check that out as well. But welcome and thanks for joining us, Lex.
Thanks, Dave. Appreciate it. Enjoy.
Finally, and last but not least, we have Sean McLaughlin, moving further west in Boulder, Colorado. Sean's the chief options strategist at All Star Charts. I've known Sean and his work. Sean is one of the most accessible options experts I know. And what I mean is if I want someone to simplify something that feels very complex, I think of Sean. You probably know Sean from a lot of his prolific work in social media. He tends to give a lot in terms of helping share some expertise on options. And Sean, it's really good to have you as part of the panel today.
Well, thanks, David. I'm happy to be here, and I love talking trading and love talking options, and this is always fun. So thanks for having me.
So I think we're very fortunate here having a group of panelists who are incredibly well experienced in a market that I find many people are hesitant to approach options because it is a new, it's a different structure, it's a different set of things. And I hope through our time today in just under an hour, we're able to try to demystify some of it, simplify things a little bit, and make people a little more confident approaching options for the first time, those that haven't done it. I'd love to talk to each of you about some of the particular areas where we get a lot of questions. Lex, I'd love to start with you. There's certainly been a growth in the interest in the options market. And I know we've seen it at StockCharts just with the questions we get about options trading, about getting started, about specific strategies. And as a result, we're trying to help people answer some of those questions. You're coming from the brokerage side most recently. Tell us a little bit about what you've seen in terms of the growth in options trading. And for individuals in particular, why is this such a compelling option for people now?
Yeah, you're correct. We have seen an unbelievable expansion of options trading in this country. Our business alone is probably up 100% in terms of just sheer volume. We can probably point some of that to the whole pandemic, right? People started working remotely, and it's very easy to turn this computer on and start trading away. That's one of the items we've seen. However, there's some other things going on too. I think there's a pretty good general awareness of options now, and it comes from all the educators. The world is the internet world is just replete with many great teachers and mentors in this space. So now people all of a sudden had this voodoo taboo type product that when I started trading 30 years ago, I was like, wow, that you guys are crazy. Nowadays it's not so much like that. People understand the product, right? And it's very easy to access, right now with online brokerage. It's become cheaper. So it's much more cost efficient than it ever used to be. There's probably an argument that it can be less risky than just trading straight equities if you're doing the right things and you understand what you're doing. And I think options offer a great strategic alternative in the fact that you can combine certain things and make spreads out of options so that you can take some of that risk out of the equation for yourself. And lastly, I'd say, this, I guess I might be dating myself, but this Gen Z world, they have everything on their iPhone or their smartphone, right? And it's very easy to do something. They've all gotten into this thing of, wow, I can make a trade with with a lot of leverage here, and I know what I'm doing. It's cheap for me to trade this thing. So a lot of those things I think is kicked into gear here, and we've seen unbelievable volume.
It's no doubt I think we've seen a growth in trading, and as I mentioned, a growth in requests that we've gotten for more education, for deeper understanding of it. Can we rotate, Sean, to you when I'm thinking of you? Again, my first introduction to you and your work was you probably on social media sharing some idea, an options trade or something, and it made me think a little bit about when I would use it. As people are approaching this, can you give us an example? Where's a particular opportunity, a particular example where it would make more sense to use an options vehicle or options strategy of some sort, as opposed to just plain vanilla equities or ETFs, which a lot of investors obviously are very comfortable with? Give us an example of where someone might lean into options for a good reason.
Sure. Well, Lex kind of touched upon this a little bit. When you want to trade a vehicle that's particularly volatile, like GameStop comes to mind, right? Like stocks are just going crazy. How do you manage risk in a stock that's moving 80% in intraday, right? Options give traders the ability to define their risks. Now, I'm not saying it's always a smart move to buy a call when you're bullish or buy a put when you're bearish. That might not be the best play, but at least you can define your risks. You know that if the worst case scenario happens, I already know how much I'm going to lose and I'm comfortable with that amount. That's where options really come into play. And whether you're doing a straight buy or call of an option, or if you're doing some kind of multi-legged spread play, the ability to define your risk is so important for options trading. And it's to me, it's the most key benefit, because stock traders, they love to talk about their stop losses and having their stop loss orders working in the market. But the stop loss order is not a guarantee to get you out at your price. If you're holding something overnight, for example, and it gaps down 20% because of earnings or whatever, your stop loss order isn't going to help you. You're going to get filled at the worst possible price at the open the next day. And with options, you can mitigate that risk dramatically.
That's a really good way to think about it. And that theme of risk management, I'm sure, is going to come up a couple of times, at least in the discussion, right? There's so much opportunity there to manage risk. And one of my concerns with a lot of new participants in the market is they don't have enough of an awareness of the risk side of it. They're thinking about the return potential, but not enough about the risk. And hopefully we give people some ideas of how to think about it. So Price, both of Lex and Sean have talked about, the growth and interest in options, and some ideas of, or example of where you might want to use it. When I think of educating people, you certainly come to mind with Big Trends and with your books and book and other places. Talk to us about the general process. How do you learn? How do you dip your foot into this thing? And how do you teach someone how to actually get comfortable using some of these vehicles they're less familiar with?
Right, Dave. I mean, most people are coming from the stock world. So it's a transition where you can't just say, well, I like a stock that's at $100 a share, so I'll go buy some 100 or more higher strike price calls and make even more money, because as the others are alluding to, there's all these other factors that go into it. So what we try to do is build a bridge in having people still think like a stock trade investor, but now on a little shorter time frame, buying, say, an in the money option. So if that stock's at 100, I'm going to encourage people to say, don't buy the 100 calls, consider buying the 95 or even the 90 calls, something that's called in the money, meaning it has intrinsic value. So if nothing happens, you don't get blasted. That's why most people that come into options not having educated themselves, they do dumb stuff where they buy the cheapies way out of the money, hope to hit a jillion times % gain, and they blow up, lose all their money, and say, I'll never trade options again. It's a terrible game. Options are actually a zero-sum game. There's money to be made on the buy side and the sell side if you know what you're doing. And so you just have to position to start with the basics. And also another thing to consider if you're a stock investor coming into options is perhaps the longer term options called leaps options that can go up to several years in duration. So you're not talking about buying a weekly option that's going to expire next Friday. it's something that's, a nice bridge also to consider. Okay, I'd like to, instead of paying, say, 10 grand to control that stock and $100, maybe I could pay 3 grand, so you don't have to get 10 to 1 or 20 to 1 leverage. Maybe you only get 3 or 5 times leverage, but you still put up less capital. You could diversify yourself across multiple ideas that way. Because the other thing I'd encourage people not to do, Dave, is say, well, I was going to put 10 grand into the stock. Now I'll put 10 grand into those options. I'd say, don't do that. Buy one contract to control that same 100 shares. And that one contract should cost you maybe $500, $600, $700, 5 to 7% of the stock cost. And you've got that other cash as your stabilizer as well. So there's a lot of elements that go into the psychology of trading and options trading success. And that's where I want to always encourage people, is not just to look at the charts and the story behind the stock, but to also think about how they're going to manage their emotions when they get into the fact of a leveraged vehicle like options. Because if you feel emotional sometimes trading or investing in stocks, you're going to feel 5 or 10 times as emotional when you have those option positions on it. And you need to be prepared for that. So start small is another thing too. Don't go all out. Start small. Assume you're going to make some mistakes. Make them small mistakes and learn from that.
Yeah, I was often told early in my career that those early losses, especially, and brace yourselves, because I will ask you later in the panel for each of you to share probably a painful lesson from your own experiences. But that's your tuition, right? That's your tuition. That's your MBA in trading and options trading, is having some early losses that you learn from, right? And that's how you start to grow. You hit on so many different things, Price, there, that I'd love to hit on. And one of them in particular was this time component. I think one of the parts of baked into options is this the idea of time decay, or that there's a limited time at which this particular thing is in place. And you talked about different types of options. Can Sean or Lex, can one of you talk a little bit more about that, how you should think of options as a short-term vehicle, but also as a long-term vehicle? How do you think of them differently on those different time frames?
If you want me to go first,
yeah, please.
I'll just say I typically don't think about options on a long-term time frame. I mean, to me, long-term is 8 months as an options trader, right?
Yeah.
So I'm typically, when I'm putting an options trade on, I have a directional bias. I have an opinion, which, by the way, is not always the case with options traders. And the guys here on the panel will all tell you that there's a whole cottage industry of people that all they do is do delta neutral credit spreads, whether it's iron condors or butterflies or some variation of that. And there's nothing wrong with that. That's great. If you've got a system, that's great. For me, I primarily, especially with all-star charts, we do directional bets. We have an opinion about where the price direction is going to go. We're not always right, of course. Nobody ever is. But when we have an opinion, we figure out an option strategy that best will take advantage of that if we're right. And for me, I'm typically looking 2 to 4 months out, 6 months out, if the volatility makes it more affordable. But it's definitely, I don't think of myself as having an investor mindset. It's definitely more about swing trading. What's going to happen over the next 2 to 4 months. That's the window I'm looking at.
I should have said long-term in air quotes, probably, to properly represent it, I guess, right? Lex, would you agree with that it should be thought of more in the short term, or how would you think of it?
Well, I have 2 answers, I guess. So I have my new retail answer, which I'm right in line with Sean. So the folks I talk to on the retail side, and I do a lot of demos and talk to a lot of retail traders. I think if I told them that the options actually expired in 900 days, they'd be like, "You're crazy. There's no chance." So they tend to stick in that, for my purposes, that what I see is probably 6 months in is where they live predominantly. Now, my second answer is going to be from my pro experience on the market maker side. We traded the whole term structure. Unlike Sean's explanation, we did not have a directional bias. So we had more of a manage the inventory bias. Inevitably, we would always be into a situation where we would probably be short premium and shorter term expirations versus long premium and longer term expirations. So we were sort of the premium sellers in the world on the pro side, right? We could afford to do it because we had a lot of leverage on the pro side. We've talked a little bit here about options as a decaying asset. There's a pretty good reason why Warren Buffett sells insurance, right? And he makes a lot of money at it. If you know the right pricing for that, it's pretty good. Much more difficult in the retail world to be on the short side of it, though. I totally understand that. What I see a lot of, little bit of short in the front months against a little bit of long in the back months. They're trying to pay for that back month longness, if you will. I'm not saying that's right or wrong. I'm saying that's what I see a lot of.
It's interesting when you were describing your role on the floor and on the institutional side. I'm struck by as a technical analyst, when I first visited options traders on the floors in Chicago, I was expecting to look at a bunch of charts with them, which we eventually did. But first, they showed me a big table of statistics. It was a bunch of numbers about, right. It was the Greeks, and it was all the statistics behind the specific contracts, and that's how they were thinking of the world, was that relationship between them. So that idea of volatility immediately comes to mind. I mean, I never thought about volatility as much as I did, Price, honestly, until reading your book when you talked about the VIX and thinking about the volatility regime and where we're at big picture. But Price, how do you think about, where does volatility fit into your perspective as an options trader, as an options investor? Is it front and center? Is it something you use, as an equity investor? Volatility is more of a nice to have down the road, but I'm assuming if you're looking at options, it's got to be more central to your thinking, right?
It has to be, Dave. And so when you're buying options, you're trying to minimize overpaying for that volatility. So that's why when I mentioned the in the money idea, that's nice, because volatility only affects the portion of the option that is the time portion of the trade. So if I can buy a 95 call and the stock's at 100, those $5 of intrinsic value don't get a volatility adjustment. They are intrinsic value no matter what. So it really gives you a nice base, especially coming over from stocks into options to start with. If you're looking at things like right in front of earnings, then you've got to be very concerned about how much you're paying. And often you're paying through the nose for betting on something that's going at the money or out of the money and making that big bet. And then there's people that trade straddles and strangles, which are calls and puts on both sides. So potentially doubly paying for that. Or if they're selling it, then there's a big gap. There's a lot of things that can happen around those big gap events like earnings, for better or worse. And a lot of times I see a lot of traders kind of get hung up and messed up by that. So we tend to be, well, we have one strategy that buys in the monies in front of earnings. Mostly we're staying away from those big gap events and trying to ride it well in front of that earnings, or the news is behind us and now we can keep trading. And then the beauty of making this transition from stocks to options too is that, and what you guys do at StockCharts, is that technical analysis becomes much more important the shorter term you get. If you're looking at making a fundamental justification for why you want to buy a weekly call option that's going to expire in a few days to a week, you're on tenuous ground of justifying it fundamentally, unless there is something about earnings or whatever that are just around the corner. Because you can buy a great quality stocks calls, but if that stock's in a short-term downtrend, you're in big trouble and may actually be really hung out to dry. So be careful about using fundamental rationales for short-term options trading. Make sure you know exactly what your indicator, exactly what your system and method is. And if it says go, get out, don't make excuses. I see that's another big problem that a lot of traders have, especially coming in from the stock world. Say, well, I like this company, it's down a little bit, I'll just hang in there on the options. You've got now a double thing you're trying to overcome of it's got to come back, and the time, how long is it going to take to come back? The time you wait is just burning against you like a melting ice cube, getting more and more melt as you get closer to expiration. So you really have to take a different mentality of being clear about how you're going to trade in options, and then saying, okay, this is my method, my system. It can't be just how did I roll out of bed this morning and feel about the market. It has to be much more systematic and take the emotions out. It'll make you a lot more effective in whatever you're trying to accomplish, whether steady income, consistent, take like Sean said, credit spreads, it's very steady. Or if you're going for growth, going for buying options, knowing that you're going to have maybe a lower win rate, but ride it when you're right. But if it's not right, get the heck out.
You hit on a number of different things that were just fantastic there, Price. And when you're talking about short-term, making short-term decisions based on fundamental data, I have a slide I usually show in my presentations. Short-term being a couple days to a couple weeks, medium-term, couple months to a couple years, and long-term is way out for the years. And the amount that fundamental analysis should be part of your thinking sort of goes very low on the left side to, much higher on the right side. And I've seen that problem too, right? You have a big thesis and then all of a sudden you're making a short-term decision based on, a information that's not anywhere relevant to your time frame. So it's a really good thought there. It's interesting when you were talking about, being, basically being able to sleep at night. I remember Price from your and my interview for Behind the Charts a while ago. When we could travel, you were telling me that if you're not able to sleep at night, your bets are too big, right? You're taking too
Absolutely.
much, biting too much off. Sean, can you talk a little bit, how do you think about bet sizing? Because when I think of you, I see you, advocating particular ideas, and that all sounds good, but how do you think of how do you weight a particular idea when you're dealing specifically with options?
Well, bet size, I mean, that's really the secret sauce to all of this, right? I mean, you could have the best ideas in the world and the best strategies in the world, but if you're not sizing your positions properly, all it takes is one bad beat and you're out of the game. All right. And I see people running into this problem all the time, and I've certainly been guilty of it all the time as well. Look, there's no shame in being a one lot trader. Okay. In fact, I tell people, if you're new to options trading, I don't care what the idea is, start out with just one lots. For me personally, I can't speak for the other guys, but I don't like risking more than 1% of my capital in any one trade. I'd rather have 100 small trades on than 10 medium-sized trades or 2 large trades. Just because I want to spread out my risks. I want to get involved in as many edges as possible and let the edges play out. And the more trades I can put on, the more likely I am to earn that edge, so to speak. And the secret to all of it is to trade small. If I'm risking more than 1% of my capital in any one trade, that's where I get edgy. That's where I get nervous. That's where I don't sleep at night. So that's really the secret sauce to all of this.
A great point. Lex, I'd love for you to talk a little bit about the leverage component. Price and Sean have kind of hit on that idea that, and I know from some of the questions we've thought of, you think, all right, if I can make 10% trading the stock, I can put that same amount of capital and just shoot the lights out by just using some call options or something. And I start sweating a little bit when I see those questions kind of come in. How do you help people understand the leverage component, how to think about that as part of your overall decision?
Yeah, I mean, I think one of the best ways, and I'm not saying go out and straight buy options or straight sell options, but just to get a graphic of it. Let's just can I use an example with this?
Please.
So let's just take a $50 stock, right?
Okay.
And if we're talking about 100 shares, you pay $5,000 for that 100 shares, right? So I think that my math's right. Is that right? 50 times 100. Okay. If you have a 50 delta option, for instance, you would buy 2 of those options to affect the same relationship of that 100 shares. Okay. So let's say those options are, I'm just making this up, $5. Okay. If that stock goes up 10% or $5 in this example, you've made your 10%. Okay. Now, if that 50 delta option has gone up by its 50%, that new option is now going to be $7.50 in this example, in which case you have a pretty gigantic return, $2.50 of $5, right? So the leverage there is pretty dramatic. Yeah. One of the things I do see a lot is the retail side likes to speak in percentages. They like to say, hey, I made 50% on my investment, or I made 67%. You can get that sort of return in options. I never thought that way on the trading floor. We thought in terms of dollars and cents. And, if I made $10,000, that's wonderful. And they say, what percent is that? I go, I have no idea. I don't know what percent it is. I have no idea. I just know I made $10,000. But you can see how that sort of relationship though can really make, the returns look wonderful. Right. And back to Price's point earlier, my risk is $5. In that example, 5 times 2, of course, because I did 2 options, but that's it. That's all I can lose. Whereas I can lose $50 in owning that stock. So those sort of plays, people can start to think about in terms of where their leverage can lie and how they can capitalize on that.
You've hit, a number of you guys as you're talking, it makes me think, for me, I have not traded options ever, and it is not my area of expertise, which is why it's not the Dave Keller Options 101 hour. It is me asking you. I've always learned, surround yourself with people that know things that you don't. And that's why I'm thrilled to talk to you guys. because I've learned a ton from talking with people that know the space better than I do. But for any of you, I mean, for someone who is really more of an equity person, trading equities, ETFs, funds, and when I see some of the options training, it sounds more like all right, if you want to quit your job and be an options trader, here's how you do it, and here's how you set your thing. But how does someone just transition a little bit so where they feel like they're not going to kill themselves if it doesn't work, but if it's more of a a learning experience? How do you start to relate your equity portfolio to your options portfolio, just from an asset allocation point of view, right? I mean, how do you get people to start to think of a portion of a portfolio that's allocated this? Who would want to take that?
I've got a thought on that real quick.
Yeah, please.
I've always maintained that the gateway drug to options trading is to sell covered calls. That's what gets people in the door. That's something that people could understand if they own a stock position. If I own 100 shares of Microsoft, I can sell an out of the money call to bring in some premium and either add to my gains if the stock goes up, or lower my cost basis in the stock. That seems to be the gateway drug that gets people in, and then everything else opens up from there.
And the cover call, essentially, for those that don't understand it, you own a long position in the stock, and then you're trading an option related to that as a way to sort of manage the risk side of it, right?
Absolutely. It's all about enhancing your yield in the trade. Now,
Yeah.
the trade-off, of course, is if you're long Microsoft and you sell an out of the money call and then Microsoft screams higher, well, unfortunately, you've capped your gains. So that's the downside, but it's a good way to get people thinking in terms of how options move and how they affect pricing.
Bryce, you were going to say something. Would
I
you
was
agree
going
with
to
that?
jump in there. I mean, the cover calls, obviously, it's a good strategy for income. It has been, as Sean mentioned, it's been tough in this bull market because things are screaming higher. And so you really got to get good at adjusting your position, buying it back. And we've got some rules for that. I was going to say that also looking over someone's shoulder who is trading for a living helps to see if you want to do that, because you might think you want to do it, but it's work. It's not like you just can sit back and be on your private island and on your yacht and just basically dial it in and pay the bills. It takes a lot of effort. So we have a Friday session where we do an hour and people look over my shoulder and see what I'm doing and then can watch on an archive, that kind of a thing. But what I was going to say too is that fit your time frame. I see a lot because of the power of like StockCharts, for example, all the data that's at your fingertips. You can shift to intraday. You could watch tick charts if you wanted to. I don't recommend a really hyper short term charts because to me, actually, there's more noise and it'll actually fake you out of your positions. At least it does for me. I'm not good with tick charts and that really hyper short term. I usually won't go below about a 30-minute chart interval myself, but that's even very active. Like for a lot of people, probably a daily chart's as low as they should go in terms of time frame, and maybe even looking at the weekly chart too, and just checking it at the end of your day, what I might want to do for the next day, kind of a thing. If you're working a day job, what have you, so you don't have to sweat it and think you're missing something that just triggered on an hourly chart. So I do think lining up your time frame with that, and then knowing that when you learn this technical analysis side and the option side, you can scale things appropriately and change your time frames to a degree and see a lot of the same patterns repeating. And so that's what we encourage people to start a little bit longer term than you might think you really would like to be, and then dial it in as you get more time and more expertise. But just really keep it simple. And we don't advocate a ton of, like Sean was mentioning, butterflies and other things that some people consider. We don't advocate a lot of complexity, and even in your option trades, even though you can make them all kinds of ratios and all kinds of wild and crazy stuff, I find keeping it simple helps me be much more effective because, like Sean, we're more trend followers. Finding that getting the stock right first is more important to us than searching an options database for the highest or lowest volatility name that may not have the stock working for it. So we like to just get the stock right first, then ride it, and give yourself more time in your option than you think you need. If you think it's going to take a week, give yourself a 1 month option. If you think it's going to take a month, buy a 3-month option. I find giving yourself more time, it takes you away from being a perfectionist and then looking back and going, if I just had that extra week or two of time, I could have been a lot better off.
Price, you said something so important there that it easily gets glossed over, in that options trading can be a swamp. If you want to make it complicated, You can make it as complicated as you want.
Oh,
You
yeah.
can start getting into volatility skews and multi-legged spreads and multiple expirations. And people do that. And that's typically where people get lost. It's happened to me many times. And there's so much power in just keeping it simple. Options can be stupid simple if you want them to be. You don't have to be making things complicated to make money. I think if you look at some of the pros out there that everybody knows, the people who have made a lot of money in options, they didn't make it because they were being complicated. They did it because they were successful because they kept it simple, and that's it.
Yeah.
I love it.
Yeah.
I'd love to ask, we've warmed up now. I think we've gotten comfortable with each other. I'd love to ask a little more painful question of each of you, just to make you guys feel a little vulnerable and share with the audience that you're going to make mistakes at some point. I would love it, Lex, if we start with you. Can you share with us a mistake that you made related to options at some point? It could be, you don't have to embarrass yourself with a recent mistake. You can make it an early formative event, but share something that you learned from.
Sure, absolutely. So I make them all day, mistakes, especially in trading. I'm the king of it. So the one that comes to mind, the most memorable and the one that really hurt the most, I traded Chrysler way back when I think it was Kirk Kerkorian was going to take it over, if I'm not mistaken.
Oh, wow. Okay.
And we're on the floor. And I had a massive position. We were market makers. So, you just naturally have a massive position in that. My clerk called me pre-opening. I like to get down to the floor just before the opening. I did all my work upstairs. And clerk calls me at home before I even left to go down to the floor. He says, I got some bad news for you. Chrysler's being taken over. And no one ever thought Chrysler would be taken over. I'm like, what do you mean? He goes, it's up like $10. I'm like, I did a deep breath. And okay, that can't be good, right? I go, how much am I down? I won't tell you the number, but I go, ooh, that's going to leave a mark. So it was the point of the matter is I went down there. Some of my fellow traders couldn't even make it down to the floor because they had lost so much money and they were restricted. We went down there and I was one of the few guys left in that pit standing, and we just continued to trade, and ultimately the day wore on and we made it all back from just the sheer volume of it, which was a miracle, by the way. But the point of the question is, what did I learn? I was short units. What that means is I was short more, and let's just call calls here. I was short more calls than I was long. I had exposure indefinitely to the upside with my short units. And we always referred to it as short units. Okay. It could be put units, it could be call units, but I left myself short units. To this day, I am still able to sell premium if I want, but they are peeled off because my units are either long net or even. So that again, back to my limited risk exposure. I'll still lose, but it is defined now. So that one mistake made me think there's no chance I'm ever short units ever again. I hope that makes sense.
It's a really good example. And again, as I've mentioned, I've not traded options, but I definitely have experience shorting stocks. And when people ask about that at the beginning, I always remind them, just remember, you have unlimited downside. I mean, you can lose a lot. I mean, the stock can go up a lot more than you think. It can go down to zero, and it's not going to go much lower than that. But you have a lot of exposure to potential upside in the stock price. It's a really good example. Price, if you're ready, give us a mistake or a challenging experience, and what did you learn from it?
I would say that I make mistakes regularly too. I would say that most of my biggest mistakes go back to ego. Ego has cost me the most money by far of any other emotion or trading strategy or anything, because I think my ego thinks it wants to be proven right. And so for example, when I got started trading, I was fresh out of graduating from Duke University. I'd gone through a rigorous educational background, very blessed to go through some pretty tough stuff and do well. And I kind of learned that the more I dig in and the harder I worked, the luckier I got, and the better the grades were, the better things worked out for me. So then I buy calls on Newmont Mining, I think it was way back when, and just bet on that. This is like going back to the 90s. Like I just was convinced that inflation had to come back. We were gonna have Newmont go through the roof, and I was not making money. It was going against me. So then I'm like, I'm right here. I know I'm right. So the market's not right. I'm right. I'm going to buy more. And so I'm averaging down. That's another ego defense. Averaging down is essentially just your ego trying to lessen the pain that you're experiencing, looking at your existing position and saying, well, I'm down 20%. If I buy just as much now, but I want to be down 10% by doubling my investment up, right? That's ego. And so just all that thinking I know I'm right, thinking I know more than the market, my ego not wanting to admit that I'm wrong, it has cost me both in doing dumb things like that, which I don't do any averaging down anymore, but also in oversizing my position. So buying like Sean had mentioned, not putting more than 1%, or even I love the one contract idea as well, like just starting small. Having a little skin in the game, I think is, once you know a little bit of what you're doing, having a little skin in the game is better than just a virtual trade that you don't have any skin in the game, because you have to have the emotional experience of seeing those green numbers adding up, the greed starting to kick in, and those red numbers adding up, and feeling that fear, feeling that, oh, what do I do kind of thing. So you have to know how you're going to manage that emotion. But it all goes back for me that ego is the most costly three letters in my trading language, and really managing that. And the best way to do it for me is systems, taking my personal ability out. And I've got people that help me to execute my systems that I've developed over decades, and constantly tweaking some of those systems too, that we don't just sit still with them, but we keep executing, and I have them help me execute, so I don't have to be the one to execute my system. So I take my ego out of that. That's actually a blessing that I have. A lot of people might not have. You might have to execute your own system, but you have to think about it as you're not just your boss of your portfolio. That's why people get excited about trading, because they say, hey, I'm free. I can do this myself. But you also have to be the employee of your portfolio. And if you're not executing, you might have to fire yourself and get somebody else to help you execute it. So work on that steady execution and take those emotions out.
That's great guides, that surround yourself with people and systems and resources to help you make better decisions. Your comments about averaging down bring to mind one of my early mentors who told me, never let your losing trades become your investments. that is a great illustration of the challenge of that. Sean, give us an example of a mistake that you've been faced with and what you learned from it.
Well, like everybody on this panel, I've been a trader for over 20 years, and I have a long list of boneheaded trades where I've lost more money than I should have lost, or more frequently than I should have. I've got all those stories, but the loss that really hurts me the most was actually not a loss at all. It was a missed opportunity. And this was a lesson that I learned that has stuck with me ever since. And the lesson is about building a plan before you put the trade on. And so I had a plan for this trade, and I'll tell you the stock at the end. I'll save the surprise at the end, but I had a plan, and I'm going to contradict myself, because I mentioned earlier how I'm typically only in trades looking out maybe 4 to 6 months. But in this one rare time, I wanted to take a long-term position. I had a long-term view. I thought this stock really had some potential. And so I crafted a plan. I've written it out. I had a yellow notepad. I had 4 pages of notes that I wrote to myself about this plan. And without boring you guys on the details, it was an options trading strategy where I wanted to buy out of the money calls, several months out. And if and when the stock moved up, I would take those calls, roll them up to the next month, roll them up a strike, basically for free, just building on the position, maybe taking a little cash out along the way to reduce my original risk. But as it went my way, I would roll them up a month and roll them out a strike, or roll it out a month and up a strike, and do that for several years if I'm lucky. That was the plan. And so what rarely ever happens, but it's beautiful when it does, I initiated this trade, and within like a week it took off. Did I know that was going to happen? No, of course not. No idea. But it did. It took off. It had a great move for 3 weeks. All of a sudden, these calls, I bought them at there were 40 calls. The stock had traded up to like 60. I mean, I was killing it on this one trade. I was easily sitting on my largest gain in 5 years, 6 years. I mean, it had been a long time since I'd seen a gain like this. And then this is where I made the crucial mistake. I didn't follow my plan. I was sitting on this big profit that I wasn't expecting to happen so quickly. And then earnings was coming up. And oh, here go the alarm bells. Earnings. Oh no. Oh no. What this thing could gap against me and lose everything. And so what did I do? I sold weekly options that were coming up as a hedge against my position. I basically hedged it up. Lex was talking about units. I hedged up my units 1-for-1, sold all the at the money calls thinking, I'm going to be able to cover these back after earnings. You know, the premium is going to come in and I'm going to pocket the profit and on those calls and they're going to expire worthless or I'll buy them back cheaper. All good. Well, you know what, guys? That stock that closed at $60 after earnings opened up at 100 and never looked back.
Wow.
That stock, this was April of 2013. This stock that I got in first at $40 was Tesla.
Oh, you might say that.
The stock has since split a couple times. You know, I can't even do the math now, but let's just say I left millions of dollars on the table because I didn't follow the plan that I had carefully crafted out and was working according to plan.
Right.
But I chimped out because I got scared I was going to lose my biggest profit of 5-6 years.
You know, it's so funny, and both of you guys have just talked about this idea of having a plan and the challenge of actually following it, right? And I've often told people from a technical perspective, you know, analyzing the chart ends up being in a lot of ways the easy thing, right? The tough thing is actually following what the charts are telling you to do and sticking with the discipline of sticking with these trades that are working. That's a painful but really good illustration of that, Sean. I'd love to talk just a little bit where as we continue on focusing on charts in particular. A number of you guys at times have talked about trend following, have talked about, you know, how you're thinking about the, you know, where the price is at. And, you know, obviously at StockCharts, our users are using charts, they're visualizing the prices over time, and that's a key part of their process. I'd love for you guys to talk about, are there particular technical approaches, or how would you describe a technical approach that is option friendly? Are there particular techniques or particular styles or looks that make sense from a technical perspective, or is it more just about structuring the options, you know, in line with what you're trying to do? How would you guys think of the technical component or the charting component to trading options?
Jump in first.
Yeah.
I would say it goes back to first, Dave, you got to define, okay, what are you expecting? Like, are you expecting, like Sean said, the next Tesla, and that you're going to have a longer term view? Or are you looking just for a window of opportunity to make a sweet spot, as I call it, out of the trend, catch that? So like a lot of times in what we'll do, like say on the FANG stocks, we trade options on the big Facebook, Amazon, Apple, Netflix, Google complex, and Microsoft is another one that I like with that. They're so liquid, they're so easy to get in and out of. And we'll use like the ADX, the average directional movement, which just shows you when you're really in a good trend phase that starts from a low level and starts to trend up. You want to just ride it while that ADX is rising. If that thing starts to roll over, we get the heck out. So we might be in and out in 2 hours. Or we might ride it for 3 or 4 days, but a lot of them are 2-day trades. So that's a very quick example. And we're using a 30-minute chart. So you could use a daily chart. You might turn it into a 1 month to 6 week kind of a trade on a daily when that ADX is in that rising mode. So, but we won't catch that Tesla move forever. You know, we might catch a part of it and then be out. So if you say, this is my objective, I'm not trying to hold this forever. I'm not trying to turn a short-term trade into a long-term investment. I'm trying to just catch what I think is a trending phase. That's a great one that I think gives you just that window of opportunity. And otherwise, I would say moving averages are great for just following just the core longer-term trends and knowing that not just to get on the right side of the trend, but also don't let yourself get on the wrong side of it. Don't fight the trend. So that's why it's just like they say, don't fight the Fed, don't fight the trend with your classic, 50-day, 200-day lines. I mean, we put the 200-day filter on a lot of our systems and it instantly improves performance even on short-term stuff because that keeps you out of trying to buy puts in a bull market that we've been in. Sure, there will be times like when the pandemic hit last year where there was a very profitable put phase there, and we did break the 200-day for just a little while. But it's one of those things where we couldn't trade it until that happened. And sometimes you're itching to get that put on when you see things starting to heat up on the downside. But you know what? It saves me for every one of those that I might miss. It probably saves me 3 of those or 4 of those that I would have been faked out of, and the market bounces right back up because we're in a bull trend. So I think it's important to know not just what to get into, but also it'll help you to stay away from otherwise pitfalls.
Mm-hmm.
Those are really, really good examples. And we often talk on my show on StockCharts TV about a market trend model, which is a long-term trend following model based on exponential moving averages, but it basically provides your green light or red light. Is this an environment where you should be looking to buy stocks or not? And that is the very first question you answer, and then you start looking for ideas that make sense.
Mm-hmm.
Lex, when you're thinking of your approach, what are there particular charts or techniques that make sense for you, the way you're thinking?
I would say generally not. We prided ourselves in my trading days on being the fastest mathematicians who can add and subtract fractions. However, as we grew into the business and it became more and more electronic, less and less from the floor, you had a certain disadvantage off floor that we had on floor. We could hear and touch and see order flow. Okay. You can't do that anymore. I mean, technically you can't do that anymore. So now you need an idea generation. And it can be anything, right? It can be technicals. It could be, I just like to be short premium or long premium, but the two gentlemen here have hit on a really important thing: discipline, education, understand your risk management, have a system. All those things are great things. In the latter part of our pro trading, we developed a technical indicator that the best way to say it is velocity. So it was a breakout sort of indicator that we used, and we created it. And it ran, the only difference is it ran electronically and it ran in an automatic fashion. The reason we did that is because of what Price and Sean hit on. We were too horrible at always interjecting our human emotion into the trade. So we finally said, wait a minute, let's let the indicator do its thing, because it was very good. And we're going to define, mathematically the exit strategy, the entry, and let the machine do it. So it was terrific that way. And you basically sat there and let the plane take off. You were the pilot. It can take off and land by itself. In case you had an engine failure, you were there to take care of it. But these are the indicators that we sort of used in those days. And we were very short term, unlike these two guys. And when I say short term, a day trade was like an eternity for us. That was an eternity. So we measured things down into sometimes even, milliseconds kind of things. So that's my background in terms of those sort of things. But I would say this, and I'll give it up here. But the folks that I talk to, they are really into technical analysis. They may be using option trades to affect that strategy, which is fine. That's terrific. But I get a lot of technical analysis sort of questions. And this T line keeps coming up. And Dave, I think you spoke about that with me once before, but a lot of folks use this T line, a good deal. And I wish I could speak to the T line, but I know they use it a lot. So.
Yeah, and I think you're right. When I've worked with people that trade options that are more technically oriented, it's the analysis of the chart is one piece, and then they've tended to think of options as, all right, what lever am I going to pull to express what I'm seeing on the chart?
Yep.
And one of my favorite first conversations about options was with an options trader where I was used to looking at charts, and if it wasn't really showing signs of being a good uptrend or a good downtrend, I'd say, all right, well, there's nothing really there. Let's move on. And he said, hold on, this is a beautiful straddle opportunity or something. I'm like, what? And I had no idea what he was talking about. But the fact that you could generate income from something that was going nowhere was incredibly interesting to me.
Yeah.
And I found that, thinking of the 3 directions, up, down, and sideways, and ways that you would express that using options is pretty compelling. Mm-hmm. Sean, how would you describe any technical indicators or particular charts that could surface up more often in your work?
Sure. So as far as indicators go, I I'm trading from a stacked deck, right? I've got a research team here at All Star Charts that does all the heavy lifting on all the technical analysis research. I trust them to find the stuff that I can't find. So I feel a little bit lucky in that regard. But I will tell you that my best setup that I find is a pretty basic one. For me as an options trader, Price talked about trends, and I totally agree with that. I'm all about trends. I don't like to fight the trend. I rarely will buy a stock on a bounce, to try to fade the overall move. I like trends, and my favorite setup in the whole world is just a simple new all-time high. If a stock is making an all-time high, and as an options trader, it's also showing low volatility, guys, maybe this makes me sound like a rube, but I just want to buy long calls. That's it. I want to ride that thing for as long as I can, because when a stock's making all-time highs, there's no overhead resistance. For a stock to go from $10 to $100, it's got to go to 11, 12, 13, 14, all the way, making all-time highs all the way. And there'll be bears that want to try to fade it thinking it's gone up too far too fast. But for me, those are my bread and butter trades. Those are the ones I like the most.
Have you been able to dig deep at all recently and find any stocks making new all-time highs, or has it been a tougher environment?
Oh no, there's plenty of stocks out there making all-time highs.
Plenty, I feel like, right? I was often taught never confuse the top of the page with resistance, and I think with a lot of stocks we're finding the importance of that. I'd love to just we have just a little bit of time left, guys, but I'd love to just talk briefly about the current market environment. Especially again, I've mentioned a couple of times, Price, your book was the first time I really thought about the VIX and how it should be a part of my own thinking about the environment, right? That just I bucket it as part of sentiment and just how things are feeling overall. And the VIX is often called the fear gauge. We've had this situation in the last year where the VIX became incredibly elevated to, the highest levels ever. And then all of a sudden settles back down to sort of this 20 to 40 range for quite a period of time. In the last month, that has now changed. And now the VIX has gone well below 20, down into 16, 17. What is that evolution of the VIX, and especially the low in the VIX, if you look at the last year, but still pretty elevated relative to historical averages? What does that VIX coming down mean for you as you're looking particularly at options? What does that mean in terms of the volatility regime or the volatility environment? Anyone
Right,
have any thoughts, Price?
So for folks that don't know, of course, VIX is pricing on the S&P 500 volatility anticipated over the next year, which, like you said, that pandemic March of 2020 peak was right in line with the 2008 worst of the financial crisis peak, things that we hadn't ever seen before, except for those two environments. So yeah, I mean, now that we're below that 20 level that was kind of holding up 19 to 20 as support, it shows you that people are into more of the risk off mode. Like nobody's really that worried, because I believe that put protection and put buying really drives the VIX. It's like, how much are people really interested in protecting their portfolios by buying puts? So if people see the market going up and away and say, well, why do I want to buy insurance and have it just continue to expire worthless and hurt my total return? And so there's less and less of that interest. And that's not necessarily a contrarian sign yet that things are a problem until we start to see that VIX start trending back up. So I think the fact that it's trending down now is actually pretty bullish for equities. And you mentioned it, Dave, with some ranges. I know Sean had alluded to it before we came on about, that VIX 20 level being so important, and I don't want to steal his thunder, but yeah, it is. I think the next time we get a spike up in VIX, probably 20 will be about the fear spike peak now that we're down into the teens. Whereas we could go down, VIX was down to about 12-ish. So at 16, we're still not at a all-time low or anything where you should be that worried yet. So I still think it's pretty bullish that we've kind of broken underneath this 20 level, because if you remember back to 2007, VIX was holding above 20 before the big '08 pain hit. So I was concerned when we saw VIX kind of hanging around 19 or 20 and thinking, are we going to get another spike up? And we saw a couple of them here up into the mid 30s. But I do think that in the longer term that it's a good sign for that we should feel good about VIX staying in the teens and not that worried about it in a longer term sense until we get back into the 20s and 30s.
Sean, would you agree with that?
Yeah, as we were talking before we went live here, is David, you and I had chatted on SCTV several months ago, and we observed this 20 level in the VIX, and I made the case that this VIX chart is important to not just traders, but to society as a whole, because we all know as market participants that the market is forward thinking and forward looking, right? And the market, while it doesn't predict what's going to happen in world events, the market's always looking forward. And I made the case that until we see VIX below 20, then we're not out of the woods with this coronavirus situation. There's a lot going on that we might see or might not see. But until VIX starts trading below 20, I'm going to still be a little bit nervous about the world situation. And now that we're seeing it hit below 20, I mean, what are we seeing in the world around us, right? Everyone's starting to get vaccines. It's getting rolled out. The death rates are falling. The infection rates are falling. The world is starting to get back to normal. And the VIX, in its own weird way, is kind of showing us that. And you know, JC and I will talk all the time, like, people aren't considering, you know, people aren't understanding what happens if VIX goes back to 12, right? The low of pre-pandemic. What does the stock market look like in that world? And the answer that you should be thinking is the stock market will be way higher.
Not lower would be my general guess.
Certainly
right?
not lower. Certainly not lower.
Lex, anything you'd add? We just have a second, but anything you'd add in terms of a market observation different than what Price and
No, I don't think much difference. I think I agree with both folks. Absolutely, that 20 is such a critical benchmark, especially when you've been coming from 80. The rearview mirror being 80, like in the near term, that 20 is a historic mark. I can tell you, you know, I've seen people buy VIX at 11 and lose a lot of money because it went to 8. You know, way back when. But this is a good sign for the market. I agree with that. Doesn't mean we won't have a spike up. We don't know where this coronavirus leads to as well. There could be some other uncertainty that's going to hit us on the side of the head. We don't know, you know, but I think this is a great sign. I agree with the two fellows on this one, 100%.
Guys, 1 hour has flown by, and it's been such a pleasure to talk to you guys. I hand selected each of you because I respect what you do, and I knew that you would have a lot of good wisdom, and you guys delivered in such an awesome way. I really can't thank you guys enough for giving us some time on the weekend to educate our viewers, empower them to make some better decisions. So Price Headley, Lex Luthringhausen, Sean McLaughlin, really appreciate the time you've given us. Thanks so much.
Thanks, Dave.
Thank you.
Thank you, David.
So as a reminder, we've had some great discussions here on what we call an Options 101 panel, really focusing on some of the lessons you can learn. You can learn more about Price Headley, his work at bigtrends.com. He does a fantastic job really educating investors on how to incorporate options into their strategy. Lex Luthringhausen, look him up at Tradier.com, and also check out his own show called Options Brew TV. I've gone on there. It's really, really well done. He brings on some really good guests. And Sean McLaughlin, you'll find his work at All-Star Charts, also on social media. He's a pioneer in social media and sharing of ideas that I'm super thankful he's done. I've learned a lot about just how to think about options from following some of his posts over time. As a reminder, go to StockCharts.com/options101 to learn more about our speakers today. Also, some of the other great sessions we did with Danielle Shea, with Tony Zhang, with Joe Duarte, some really good educational content. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.